If you hear anything or
Good afternoon and welcome to the summer 2022 Linneman Associates Capital Markets webinar presented by Linneman Associates and Real Estate Financial Modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, provider of financial analysis tools and training to the CRE business since 2009. We're pleased today to have an insightful program for you, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, for which those of you who do not know is a strategic and investment analysis advisory firm. We're using GoToWebinar, and I'd like to address a couple of housekeeping items before we get started. On the audio front, all of the participant audio is muted, meaning we cannot hear you, and that is by design, and that will remain the case throughout the webinar. If you're attending by computer, take a moment to familiarize yourself with the control panel. We will be showing the slides, but if you would like to download them, find the handout section and click on the file name. You don't need to have the slides up during the presentation because they'll be shown in the viewer window, but you're welcome to keep them for the future. And as always, we've reserved 15 to 20 minutes at the end of the webinar to answer participant questions, but please do feel free to submit your questions at any time during the presentation by clicking in the questions field, typing your question in, and make sure you click the send button. If at any point you get disconnected, just reconnect the way you did originally. And if you are registered, you will automatically receive an email link to the recording of the webinar about 1 hour after the completion of the session. And without any further ado, I'd like to introduce the presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, over to you. And where are you in the world today?
I'm sitting in a very hot and very humid Philadelphia. It's summertime in Philadelphia, sort of 95 and 95 degrees and 95% humidity. So hopefully this is Philadelphia summer. So let's start with the first slide, which is U.S. Deaths associated with COVID and its variations. And the only reason I use deaths is while there are measurement issues of why did somebody die and was the death caused by, or did they just have it at the time, it's a relatively consistent measure, certainly not perfect. And you can see it is a fading concern, at least as it affects the economy. Still a very real disease, still a very real health concern. One of our staff recently has it, and I imagine a fair number of you have either had it or know somebody who's got it or about to get it. Take it very seriously and stay up to date with the best ways to stay safe. But at least from the economy point of view, it appears to be a fading concern. Go to the next chart. The aftermath of COVID, and the policies adopted with COVID continue to reverberate through the economy. So on this chart, we've got 3 lines. One is the 2019 peak real GDP. Anytime I say real, it's just adjusting for inflation. The blue is actual real GDP, and you can see how severe the drop was. And then the red is what would happen if GDP had grown at 2.5% a year in the period since that peak back in 2019. And what you see is the economy did a rapid drop, a fairly rapid recovery, and then a long upward slog recovery. Real GDP, the blue, has fallen in the last 2 quarters by a total of about 0.3 percentage point, not annualized, but actual, about 0.3 percentage point. It has done that, however, as you'll see, as the rest of the economy is in anything but something that looks like a recession. So we'll come back to that theme. but I wanted to highlight we are above the old peak of real GDP. We have been since early 2021. We have seen this very slight dip, but the more important thing is we're way short of where we would have been had we simply just kept growing at 2.5%. The reason that's important, I think, is to understand this is not an overheated economy. An overheated economy would be one where the blue line, the actual, is way above the red line. That is, we're way above a simple trend over that time period. Well, and you can see that's not the case. We're sort of 2%, 2.5% below where we would have been if all we'd have done is continue to grow. So when people tell you that demand is overheated, we have too much demand in the economy, they're just wrong. We have an underheated economy still, but what you're going to see is we have underheated supply. And what we really have needed, and we've needed for almost really since early 2021, we need policies that will bring back supply. Go to the next chart, and one of the things that is being supplied is labor. And I'm tracking private sector employment, and this chart is not inclusive of the employment number that just came out at the end of last week, which changes it slightly. And again, 3 lines. We're tracking private sector employment. Yellow is the end of February 2020. Monthly data is available. That's why we pick up that month. And the red is what would have been the trend employment continuing. And the blue is actual. And again, you see this staggering drop, losing like 25 million jobs in a matter of weeks, and then a slow slog recovery. Remember that in early 21, real GDP had crossed into above the pre-pandemic. We just crossed at the end of July, we just crossed where we have more employment than we had prior. That's good news. But again, you can see the supply is about 2% below where it would have been had things just grown at trend. So labor's coming back, keeps coming back. It always lags the economic recovery. It's done it again, but it is coming back. One of the most bizarre things is people keep saying, and they said this from that April 20 low, they'll never come back, they'll never come back, they'll never come back. And essentially every month since April 20, the headlines are full of people saying, oh, workers are never coming back, they're never coming back. I want you to just imprint this chart in your head. They are coming back. They're coming back with a lag, but they are coming back. And last month we added 528,000 jobs in 1 month. We've added in the first 7 months close to 2.9 million jobs. So they are coming back. They're just coming back with a lag, and that lag is what puts the pressure on wages and makes markets tight in the labor market. Go to the next chart, weekly initial unemployment claims as a percent of the labor force. And you can see how unprecedented the rise was during the pandemic. And that's an important thing to remember. We have never witnessed an economic shock like we went through. And it's easy to forget that just a little over 2 years ago, the streets were empty, looked like a science fiction movie. People huddled in their homes. We have gotten back. The unemployment claims are back to normal, but they are rising. And it's hard to pick up in this chart, but in the last 4 weeks, it has risen from real lows to solid. Not great, solid, certainly not bad. So it's something we're watching. The labor market on that side is showing strength, but notably reduced strength. Go to the next chart, the unemployment rate. You see the unemployment rate of teens, which I love to track because it hyperreacts, and it's still very low. And as you can see, when labor markets are weak, you see it really dramatically and quickly in teens, in the red. Way below average and still falling. So the labor market is very strong still there. And you see it in the overall unemployment rate, which I think just hit 3.5%. So we are in a good situation there. Go to the next chart. This is the percent of industries adding workers. And you can see that this is very high by historic standards. Normally, a good economy, you'll have something like 60 to 70% of industries adding workers. You can see we're up near 75 to 80% still adding. So it's still an economy that shows strength. Why are they adding workers? Because they're trying to catch up. They're behind GDP. GDP has room to grow. There's pent-up demand. And so that's what's going on in the economy. Everything is about recovering from the most extraordinary economic event, at least since the Great Depression. And in a way, even more unique than the Great Depression, because it wasn't caused by economic factors. It was caused by epidemiological factors that reverberated on the real economy. Go to the next chart. This is job openings. And we've marked the low and the high over the last 20 years or 21 years. You can see that we're at an all-time high, by far, at an all-time high. We've added 5 million job openings since the recovery began pre-pandemic. We have flattened out. If you look at it's hard to, again, pick up on this chart because of the scale. Over the last basically 6 to 8 weeks, pretty flat, maybe very slightly down. But there are a lot of job openings. And in fact, there are many more job openings, almost twice as many job openings as people who say they're looking for work. So it wouldn't be so unhealthy to see this fall a bit, in the sense that you would love to see it fall if people are taking those jobs. And one of the reasons this has fallen in the last couple of months is because we've added 500,000 jobs one month and 450,000 jobs the next month. So they're eating into that stockpile. Go to the next chart, and people tell me, well, where are the missing workers? I've highlighted here the labor force participation rate of people 65 years and older, because that is the one category of workers that has not gotten back to its pre-pandemic labor force participation rate. And some of those were highly skilled, some of those were low skilled. And what happened was, clearly, if you lost your job, you took your unemployment and called it quits. And I want to highlight, people basically since 1983, the labor force participation rate of this population has been rising from about 11% up to 21%, and was at an all-time high and was continuing to rise because, let's face it, people who are 70 are healthier and much more able to work with longer life expectancies than in the past. But I circled two areas. One, you see the dramatic drop that happened among this group. And then you see it's recovering. It's recovering, but it's not recovered. That's the missing labor force. Contrast that to the other circled in red, which is during the financial crisis. And during the financial crisis, this age category had labor force participation rise unabated, as if nothing happened. You would never guess there was an economic downturn, much less a severe economic downturn, as you look at the circled area to the left. That was a severe recession, as you recall. And yet the fundamentals of this age category, wanting to work and going to work, were so overwhelming that it powered right through it. All the other age categories got hammered and fell. This time, even this sector fell. The cuts were really deep. The companies going out of business were really widespread, and the unemployment benefits were such that a lot of people just called it quits. When this participation rate gets back up to where it was, is when you'll see labor markets ease. It is less about young people. Young people have to go to work to eat and to house themselves. The older is at a more marginal point in their career in terms of, do I want to work a little more or not work? So this is an important category and the main reason that you have tightening. If you go to the next chart, it's another shocking insight on how unprecedented this shutdown and pandemic-related problem were. And you see that during the financial crisis, we had about 9% of the population of the labor force, collecting unemployment insurance, about 9%. That was really high by previous historic standards. Overnight, we went from essentially no one receiving unemployment insurance benefits to 22%, 23% of the labor force receiving unemployment insurance. Unprecedented, shocking. And that's why when they tell you that the unemployed, the actual number of unemployed clearly undercounted how many people were unemployed during those early months, because you can just see who was collecting unemployment insurance. It's pretty staggering, actually. This is back down to normal. And it stayed above normal right until a year ago, September, when the people making less than $25 an hour were no longer paid more not to work and stay on unemployment than to come off of unemployment and go to work. And since then, we've had an explosion of jobs, which is exactly what I predicted, even as most people were saying, nope, they're never coming back. They're never going to come back. And you go, it is just so stunning how obvious it was. Go to the next, the consumer. Consumer is the most powerful, important factor in the economy. Consumer confidence index, I've circled, took an enormous drop from pretty close to an all-time high, took an enormous drop, and then rebounded as that labor market returned, as growth was occurring. But what you can see is over the last 6 months, consumer confidence has fallen. It's still above average. The red line is the maroon line in a tip of my cap to the University of Chicago. The red line is the average, still above average, but weakening. And as I said to somebody, if a nuclear power is in a shooting war, you should have less confidence about the state of the world. And then you add to it the knock-on effects with oil prices that came out of that, and food issues around the world. And there's an upcoming election, and how high would interest rates go, et cetera. You should have less confidence. And I think what we started seeing over the last few months is the swing from greed to fear, or another way of saying it, probably a more accurate way of saying it, the swing from optimism prevailing over pessimism to pessimism prevailing over optimism. And you've seen it in capital markets, you've seen it in a lot of areas, especially banking. Go to the next, small business. Small business optimism was about average and has plunged in the last year. And it's done this not coincidentally, as the regulatory outlook has become much less favorable. Remember that regulatory burdens fall way disproportionately on small businesses. This is because they don't have the money and capacity to lobby, to use the regulations as much to their advantage, and compliance costs tend to be relatively fixed and therefore are disproportionately burdensome on small firms. I did a study in about 1980 on the mattress safety standard and found that it just killed small firms. The big firms did just fine, but the small firms got killed because of the fixed cost of the regulatory and that the lobbying was driven by the big firms to make standards meet their products. Go to the next, the two main durable items for consumer, housing and auto. They're indexed here so they can fit on the same chart. You see how coincident they have tended to move from 76 until 2007, and then they decoupled. And in 2007, the blue housing went way below auto. Auto rebounded, took its normal path as short-term interest rates cut off a major source of down payment capacity through intergenerational transfers. Housing languished, it went flat. It had never been flat like that before. It climbed back. It climbed back a lot, not because interest rates were low during the pandemic, but that the combination of I had nothing I could spend my money on, and I had a lot of involuntary savings, and people saved as much in 9 months as they probably did in 7 or 8 years, gave them money for down payments, which fed the housing market, and premature deaths from COVID created premature bequest receipts, and those allowed down payments. So you see the blue has actually recoupled with the red, and in fact, the red has not rebounded as much until very recently. And that's an important last bit of the chart on the red, the auto. There was plenty of demand for autos, no shortage of demand for autos. What there was a shortage of capacity of autos. And in particular, it wasn't just chips, but in particular, chips were a main factor there. So even though there was demand, there wasn't supply enough. Pushed up auto prices enormously, pushed up used prices enormously, because if you're not getting as many new purchases, you're not getting as many cars put into the used car pool. Well, you can see at the very far right, the autos, the red has jumped up. That's because chips are coming online pretty quickly. And what was a shortage that some people were saying, oh, it's going to last 2 or 3 years, and I'm going, I don't know, I doubt it. Most things don't last in shortages that long, absent government shutdowns of capacity. Well, sure enough, chips are coming back, and now people are talking about there's going to be a glut of chips in about 6 months. This sector is coming back, and it's an important sector along with housing that will drive things. You can go to the next chart and you see the home ownership rate. The rise from 96 to 2002 that occurred was the aging of the baby boom. The rise that occurred from 2002 to 2006 was driven by the fact that down payments went from 10 to 20% to 1 to 3%. And if you've got that down payment, people bought. When you went back to 10 to 20% down payments in 2006, and there were some capital market dislocations and short-term interest rates stayed very low, which meant there was no income for safe savers on their CDs and bank accounts. Intergenerational transfers dried up, and you saw the home ownership rate fall. In addition, it was partly the millennials, which is a big cohort, were moving into their renter years. You then saw, as the millennials began to age and move into their owner years, 2016 to just pre-pandemic, it was climbing again. We had written about that 10 years earlier that it would happen. And then you see the spike. And the spike that you see in home ownership is involuntary savings and premature inheritance, creating the down payment capacity. And you can also see that that's normalized, and you're getting back to a much more normalized level of home ownership. It will still drift up a little as millennials continue to purchase. That's a demographic phenomenon. Also, as the well, let me come to the next chart, actually. I'll do the next two charts. So if you go to the next, this is the cumulative shortage of multifamily starts relative to general demographic demand over the last 20 years. And you can just see creeping NIMBYism set in. Creeping NIMBYism got accelerated by the financial crisis, which saw financing for construction disappear. And for 2 or 3 years, we actually destroyed multifamily units on net. We didn't build enough to offset what was destroyed. Slowly, we're reducing this shortage. It's about 600,000 unit shortfall nationally on about a 44 million unit stock. There's about a 1.5% shortfall of multifamily units out there. If you say, why has there been upward rental pressure over the last decade, it's this chart. If you have a shortage of something relative to demand, you're going to see rents outstripping inflation. Go to the next chart, and you'll see it even more dramatically, but in a different way for single family. And you see that from 2002, we started in a pretty balanced market, but by 2006, 2007, we had an excess of 2.1 million units. That's when there was no down payment. People were buying not to live in their homes, but to speculate on homes. They were trading homes. And then you can see supply must have shut down because we go from an excess above the line down to a shortfall. And we cross over at about 2012. Well, when did home prices start outstripping inflation? 2012. It was not about the interest rates. The interest rates certainly added pressure in that regard, but it's a fundamental shortfall. It's a shortfall of at least 3.2 million units. You could get it as high as almost 5 million units. I come out at 3.2 being conservative. That's about a 3.4% shortfall of single family units nationally. Now that means some markets are pretty good balance, but if you show me some market with pretty good balance, I'll show you one that has to be even in worse balance. This shortfall, when do you see home prices start outstripping inflation and wages? As this chart goes more and more negative. You can see that over the last 3 years, what has happened is the shortfall remains. It's not growing, it's flat. And what we've got at this point is we would have to build 3.2 million units beyond what we normally build to get rid of this. And until we do, there will be upward pressure on home prices. That upward pressure means that they're generally going to outrun wages. Wages tend to rise about 1% above inflation over the long term. And as a result, what you're getting is homes become less affordable, that it is not the monthly that is the big problem because, yep, and by the way, even if interest rates go up, it's not the monthly that's the problem. The monthly means, okay, instead of upgrading the kitchen before I move in, we're going to do it 2 years from now. We're going to live with the bathroom needing upgrading. We're going to buy a new home that is 100 square feet smaller. That's what the interest rate does on single family. What down payment does is say, I can't do any of those things even if I want. And the fact that prices are rising faster than income and that rents are higher mean that people have to save longer. They have to rent longer in order to assemble the down payment, with the exception of during early COVID, where you had huge involuntary savings and early inheritance. Those were the exceptions that changed that. Now we're back to kind of much more normal in that regard. Go to the next chart. The household is in pretty amazing shape. If you look at their debt service, it's up, but it's still pretty low by historic standards. And you can see mortgage debt and consumer debt are both at quite low levels, and the total burden is quite low. Go to the next chart. Let's turn to the corporate sector. Real corporate profits, basically flat after taxes. If you look at the red, they're slightly rising over time, but basically flat, which is to say profits are rising, but they're rising at about the rate of inflation. But you can see that companies have normalized undistributed profits, and that distributed profits have continued their upward climb. So companies are in pretty good shape. Now go to the next chart. If you go to the industrial sector, you'll see that industrial output, we mark in the green the pre-pandemic high. You see again the dramatic drop, the slow recovery, kind of butterflying up as it goes. And by essentially the beginning of this year, industrial output was back to where it was 2 years earlier. But remember, GDP at that point was 3.5% above. Not a big shock that if industrial activity is only up 1% or so, and while demand, kind of proxied by GDP, is up by much more, you get price pressure. I mentioned what an odd situation it is that real GDP was down, even though jobs are being added left and right. Industrial output, look at industrial output. Industrial output has grown about 4% so far this year. It is a very unusual notion of a recession when you're adding 400,000 and 500,000 jobs a month. Industrial output is increasing at 1% a month. You have record job openings, record retail sales, etc. Economic activity is continuing pretty well. And in fact, go to the next chart. This is real brick sales. This is sales going, as best I can measure it, through brick stores. And it's not perfectly measured. The red is the pre-pandemic high. You see how dramatically it fell when restrictions shut down malls and so forth. And exactly as I thought, it bounced back. We're at record sales. They are not rising over the last year, but they're staying high. And again, that's a very odd recession where you have record retail sales. Brick is hardly dead as we had forecast. It wasn't. Go to the next. This is e-commerce sales as a percent of total retail sales. And we put the red line simply to give you a sense of a simple trend. Look, what happened was that when you couldn't shop where you wanted to shop, you did the best you could or you forestalled. And now what you're seeing is e-commerce is coming back down towards trend. Do I literally mean that trend line? No, it is coming back down towards trend. You could do the trend over a shorter period, it'd be a little steeper, but it's reverting back to normal in that regard. Let's quickly go, Bruce, to the capital markets. Go to the next chart. It is hard to believe that this is 10-year Treasury and the Fed funds rate. If all you did was see the last part of this chart, it's hard to see why people are committing suicide over interest rates. If you look at the 10-year rate, which has actually dropped a little bit since we did this chart, and is bouncing at something like 2.7, 2.8, and the Fed funds rate, which is bouncing around 2.25 to 2.5, where is the oppressive interest rate environment that I keep hearing people talk about? If all you did was look at today's interest rates, you would largely find one of the most accommodative interest rates environments in my lifetime. Literally in my lifetime, particularly for the real estate business, which is much more dependent on long rates than short rates. You add to the fact that all the research that I've done, seen others try to do, shows that there's not much of any correlation between interest rates and cap rates. And you sort of go, I don't get it. Now, what I do get is that rapid rises in the short-term rates raise uncertainty about what will happen, as does a war in the Ukraine, as does the oil effect knock-on, as does inflation caused by a shortfall of supply relative to demand. And I do see that what's happened is greed is now losing to fear. And the banks have gotten skittish in lending, and there are broken deals, and buyers are saying, I want to retrade a deal. And that happens. That happens. It is not about interest rates. Interest rates or broken deals are reflecting fear. Fear. I can wait. I can wait. I can wait. And so I think that people are very much misdiagnosing. If you go to the next chart, you'll see the multifamily cap rate spread. The main reason I do the multifamily is it's easier to know what you're looking at, simply because it's current income is current income, whereas with office, you have issues of rollover, longer leases, etc. The cap rate spread is tight, although has widened, and it's people who say, oh, cap rates are caused by interest rates. Ask them why cap rates haven't fallen 70 basis points in the last 6 weeks as the long-term interest rate fell, and ask them why they didn't rise earlier. The spread, if you look at it, the spread absorbs a lot of movement in interest rates. The spread is much more volatile than people realize and is absorbing most of the movements in interest rate that happen, long-term interest rates. Go to the next chart, capital market. You see banks' excess reserves. They're essentially banks, all reserves are now excess, but that's a technicality. to make this apples to apples, banks went from having no excess reserves prior to the financial crisis to a lot from QE1, a lot more from QE2, a lot more from QE3. And then you see they ran down their reserves. Well, they ran down their reserves by expanding loans that fed asset prices. And that's the part I put the red around. And then you see QE infinity ran up reserves even more. And you can see we're in the early part of a repeat of that coming down as banks will use those reserves over time, not in one day, over time, and in the process will lend primarily to asset buyers, which will primarily feed capital into assets, including real estate, which will tend to keep pressure on cap rates to remain low. Go to the next, you have inflation, 3 measures, core CPI, which eliminates food and oil, but remember when it eliminates oil, it doesn't eliminate oil's knock-on effect in other products like plastics and resin and toys made of plastic, etc. The consumer price index for services, and you also then have for all items. About half of all inflation relates to oil these days. If you look more carefully, you'll realize that oil has fallen in price by about 25% in the last 6 weeks. That is starting to show at the pumps. It'll start to show in other products. You're starting to get capacity. I showed you the industrial output coming online. I talked about chips, lumber. Those of you on the construction side, development side, know what's happened to lumber in the last year. You're starting to get weakening in inflation. And I think by the year end, you're going to have much lower inflation rates. But in the meantime, what this inflation is doing is sending signals of where we need more capacity. Inflation generally is matched by wage increases. And in fact, wage increases, as I mentioned, usually outstrip inflation by about 1% on average, not at every moment in time, but on average. This has been a very unusual situation in that the inflation sprung up so fast that a lot of employers made wage determinations late last year thinking they were giving their employees a real wage increase, only to find out they're giving them a real wage reduction of 2, 3, 4, 5%. And employers, some I've spoken to, including us, have made mid-year adjustments. I've talked to a number of firms doing that. Others are saying they're going to do it at year end. Workers' wages will catch up. However, in the short term, it is a problem, particularly for mid-wage workers. It's a problem. Real quick on inflation, go to the next, just talking points. When we shut down the economy, you go to the next, when we shut down the economy, either supply was going to come back faster to demand, in which case we'd have had big deflation, which would have been a disaster, or as more likely, supply was going to lag demand, in which case we were going to get inflation. Well, that's exactly what happened. We had unprecedented shutdowns, and we go back to those charts. Nothing before ever remotely like it. And that's why this inflation is driven by something we've never before seen, which is fundamental shortfalls economy-wide around the world in supply. It is not caused by overheated demand. It is not caused by excessive money. Most of the money that went in the system still sits in the banks, not circulating, velocity plunged. So we need capacity to come back. Higher taxes are not going to encourage capacity. Higher interest rates are not going to encourage capacity. More regulations, not going to encourage capacity. As things come back, you will see inflation moderate. And it's just another cost of COVID and COVID-related policies. Very sad. It's less sad than losing your father dying prematurely to COVID. It's more sad than I couldn't watch the Phillies play terribly in 2020. I mean, so it's all just a cost. But, I was a Milton Friedman student. I find it interesting that Keynesians spend their whole life attacking Milton. And now they all quote his inflation is always everywhere, a monetary phenomena. But the rest of that sentence was because it is inconceivable that we would have economy-wide shortages of a magnitude that could generate inflation. Well, Milton, to be fair, never envisioned shutting down the economy. He never envisioned forcing 23% of the population onto unemployment insurance, etc. Absolutely unprecedented. And that's why we have an unprecedented caused inflation. So we have to go to the next, I'll skip over, but you can look at this. What was stagflation? Stagflation occurred at a time when Keynesians had this theory that higher inflation led to higher growth. And what happened was we had higher inflation and lower growth, and they were shocked. And it turned out it just proved that the theory on which they were basing it was completely wrong. Why did we have slowdown? Well, we were an oil importer and oil prices went up. We had an explosion of regulations. The Federal Register, which reports all regulations, etc., went from 10,000 pages to 90,000 pages in a decade. So, I mean, it was a very, very different situation. Yes, we have high oil prices then and now, but we're a net exporter, not a net importer. So it's a very different scenario. We also had wage and price controls. Go back and look at what happens. We describe it in the Linneman letter most recently, what happened to the regulatory environment. Pretty shocking, actually. Of the 6 trillion growth in M2 that people talk about, only 1 trillion of it is circulating. The other 5 trillion is sitting in bank accounts, not circulating. 4 trillion in household bank accounts, 1 trillion in corporate accounts. So it's not like all that money is going around. And I'll show you 2 quick charts. Go to the next one. You do see M2, which is a measure of money supply, going up and then really going up as a result of the financial crisis, and then going up like a rocket ship. And that's what everybody talks about, must be fueling inflation. But what they don't focus on is, go to the next chart. How fast does that money spin? So you can imagine I keep putting more money into the system, but if it doesn't churn, if it doesn't do anything, it doesn't create any price increases. And you can see the drop after the financial crisis in velocity, unprecedented to go that low. And then you really see to the far right that when the rocket ship injections of money occurred in the previous chart, you had a rocket ship plunging to the earth in terms of velocity. And so I just don't think it's about the money supply. We have an underheated economy with really underheated supply. And go one more, you see the checking deposits and currency rose post-financial crisis with all the injections, and then you see it really rocket ship. And that's when you saw that rocket ship M2, that's when you see the $5 out of $6 that were injected going up. Really quick, you've got the S&P 500. It's down about 12% year over year. we're in another episode of greed losing to fear. If you go and look at the long-term chart of S&P 500, one thing you learn is it always wins in the end. That is greed. On the oil sector, you see Permian Basin rig count is rebound. No, go back one. Go back one, if you would. You see just stay where you're at then. You see the Permian Basin rebounded. What you now have is oil prices. We're at 125. They're down. Go to the next, if you would, Bruce. As supply is coming online. So you're seeing more supply coming online. And oil prices are falling, not rising. And in fact, when oil prices were at 125, I did a webinar. People asked what I said the price would be a year from now. I said it'll be a lot closer to 80 than 125. So far, that looks like a good bet. I think, Bruce, what I'll do is just go to the last slide, which is big questions abound. And how high will inflation go? I think we're right around peak. And by year end, I think we'll be in a much better place. Will there be a recession soon? I don't see it. I understand it is actually a replay of if you believe that inflation can cause a recession, yeah, but I just don't see this happening. Will the Fed raise rates too high? Always a serious possibility when you mess with mother market. So far, they haven't. Will regulation slow growth? Of course. By how much? 0.2% of GDP. Will taxes rise? It looks like it's almost certain that they will, but not a lot for most people and most businesses. Will that be a drag on the economy? Yeah, probably 0.2% of GDP a year. Will people come back to work at offices? I think we're in the early stages of absolutely. And I look for a big change between now and a year from now in that regard. What happens in the November elections, I'm not a political maven. I feel pretty good that the Republicans are pretty clear that the Republicans will take the House. The Senate looks closer. My gut tells me that it'll end up Republican in both, but there's still a lot of things that can happen between now and then. Let me stop there, Bruce, and we have about 5-6 minutes for questions.
Great, thank you very much, Peter. There are a lot of multifamily professionals on the line today, and several have written in wondering if you have any thoughts or opinions on where multifamily cap rates are going to be going in the next 3 to 5 years.
In the next 3 to 5 years, I think they stay where they're at to slightly lower. The reason I believe that is the flow of funds. I think that the $5 trillion of cash, some of it will rotate to assets like multifamily, not just multifamily, but like multifamily. And I think some of those excess reserves are going to come out and chase real estate products. And I just think there's more money coming out. That doesn't mean, in fact, when I wrote about this a year or two ago, I said that I viewed the arc was slightly downward on cap rates, but noted there will be episodes when greed loses to fear. We're going through one of those. But on the other side, greed has always made a terrific comeback.
Thank you. We had a few different individuals write in regarding the excess bank reserves slide that you had walked us through. Given that it's still so healthy, folks want to know why have certain players reduced their appetite on the lending side? Like, well,
real simple. They don't have to do it today. They have to do it sometime, right? They have to use some of those reserves sometime. This is not a situation like 1990, 1991, or 2000 or 2001, I mean, or the financial crisis, when they didn't have money. They have tons of money, and sooner or later, they're going to lend it. But sooner or later does not necessarily mean now. And so the skittishness coming out of the banks is not because they don't have capital. They'll tell you they have tons of capital. It's coming from, well, let me get greater clarity. Let me just get a little greater clarity. I don't want to look like an idiot. But they can't sit on all their money forever. They're banks. The way they make money is lending. And so you're going through, again, a pessimism period rather than an active period.
We also have a lot of developers on the call, and they have construction cost inflation on the brain. Do you expect that construction costs are going to moderate as well as other elements start to moderate?
Dramatically in the next year, and one of the most dramatic moderations has already occurred in the construction industry, and that's of lumber. Lumber, I think, hit 1840 or something like that, and it's bouncing around just around 500. And that's a notable drop. Labor is improving. At least as I talk to people, there's more available in trade. Copper, just to pick something, and commodities in general are down 35% over the last, whatever, 5 months, something like that, as capacity comes on. Oil being down will be reflected in a lot of materials, building supply materials. So yes, they're going to be higher than you were used to in 2017, 18, 19, but the inflation, the rising, will moderate, and we possibly, very possibly, could get a period of negative or deflation in construction costs, because some of these items could come back and create gluts of product.
We've been talking about this for a while now, and you are very firm in your belief that there's going to be a tipping point with the return to office. Do you still stand where you stood before? You think that it's gonna happen, it's just a matter of time, and when it comes to people trying to move up to get the big promotion, they're gonna show
up? Absolutely. And I still believe there's a tipping point. You're still seeing employers saying, Comcast here in Philadelphia, a huge employer, just announced that they're coming back to the office. Once people come back to the office, there's a reason to come back to the office. And if no one's in the office, what's the point of me coming in? If, by the way, I come in, but none of the companies I work with are in, that greatly reduces it. If I'm coming in, but nobody I'm working with is in, or my bosses aren't in, what's the point of coming in? It feeds on itself. Look, I spent my career as an educator. I've done a number of online classes. Zoom is lovely. I mean, okay, it's great, wonderful. You get to see postage stamps of people. But the productivity of a class delivered online versus in person, night and day, just night and day. 30, 40, 50% more productive. It's the interchange of ideas. It's the excitement of the interchange of ideas. It's the interaction of ideas. The same thing is true in the office for many, many aspects. Is it true of all of them? No. But it's not like people were chained at their desks before. A lot of them were already on the road working remotely. A lot of them did work a day a week remotely. I just think people are coming back, will come back because they're more productive. Right now, you have an odd phenomena, Bruce, if you think about it. It's a good thing to end on, maybe. We have an odd phenomena where you had college students or graduate students who, for the last year and a half of their career, were remote. And they really liked no answerability in that regard. They really liked having their pajamas on while they were in class. And they really liked it at work that way. But there's reality, and the reality is most people, most of the time, are more productive at work. Not all people, all of the time, just most, and that's why they came to work before the pandemic, and that's why I still believe they'll be back after.
Wonderful. Thanks so much, Peter. Unfortunately, we're not going to be able to get to all of the questions that have come in, but I want to make sure everyone knows that this presentation is just a digest of what's given in a lot greater detail in the Linneman letter, which is a quarterly subscription from Linneman Associates. More information on that can be found on the Linneman Associates website, linnemanassociates.com. As a reminder, if you are registered, you will automatically receive an email link to the recording of the webinar in about 1 hour. Well, thank you again, Peter, and thank you to everyone for joining today, and we will see you back next quarter.
Terrific. Thank you.